Hello everyone. Welcome to the lecture on the role derivatives played in the 2008 financial crisis. Warren Buffett once called derivatives financial weapons of mass destruction. And today we will explore why. The 2008 crisis was one of the most severe economic downturns in the recent history. And understanding the role of derivatives in this event is crucial. Before we discuss the crisis, let's recall what derivatives are. Simply put, derivatives are financial contracts whose value is derived from the underlying assets like stocks, bonds, or loans. These instruments are used for various purposes such as hedging, arbitrage, or making profits through speculation. In the years leading up to 2008, derivatives like mortgage backed securities, that is MBS, and credit default swaps, CDS, became extremely popular, especially among banks and financial institutions. If you examine a bank's balance sheet, you will notice two main sections: assets and liabilities. The bank's liabilities primarily consist of demand and time deposits collected from their customers, as the bank is obligated to repay these deposits along with an applicable interest. On the other hand, the loans that the bank extends to borrowers are considered its assets, as they generate income for the banks in the form of interest. However, if these loans, which are assets for the bank, are not repaid on time along with interest due, they are classified as non performing assets, which are NPAs. So, banks generally strive to increase their loans. This is because lending is a primary source of income for banks. When a bank extends loans, it earns interest on those loans, which contributes significantly to its revenue. The more loans a bank can issue, the more interest it collects, leading to higher profits. However, while banks aim to increase loans, they also need to manage risks effectively. So, lending comes with the risk of defaults. So, banks must ensure that they lend responsibly to maintain a balance between growing their loan portfolio and minimizing a potential losses. In the years leading up to 2008, banks in the US gave out subprime loans for several reasons. A subprime loan is a loan given to borrowers with a low credit scores, carrying higher risks because they are more likely to default on payments. Let's break down why they did this even though these loans were risky. First, the banks were driven by the opportunity to make huge profits. During the early 2000s, the housing market was booming, and banks saw a chance to capitalize on it. By issuing more home loans, they could collect interest payments and fees, which translated into higher profits. Second is a securitization and mortgage backed securities, which is MBS. Banks realized they could bundle home loans, including risky ones, into packages called as mortgage backed securities and sell them to investors like pension funds and hedge funds. By selling these MBS, banks could get their money back quickly and transfer the risk to these investors. This let them free up capital to make more loans, as they didn't have to keep the risky loans on their balance sheets. In short, securitization allowed banks to issue more loans without holding on to the risk. Banks and other lenders assumed that the housing prices would always go up. They believed that even if borrowers with low credit scores, that is, subprime borrowers, defaulted on their loans, the bank could still recover the money by selling the houses at a higher price. This overconfidence in the housing market created a sense of security, leading banks to issue more and more subprime loans. And there was a huge demand for mortgage backed securities from investors like pension funds, hedge funds, and other financial institutions. Because during the early 2000s, interest rates in the market were very low, which meant traditional investments like government bonds were offering lower returns. Investors were looking for ways to earn higher returns in a low interest environment. And MBS seemed like a safe, profitable investment. MBS were seen as relatively safe because they were backed by thousands of individual home loans, which diversified the risk. The thinking was that even if some homeowners defaulted, others would continue to pay. So the overall risk was spread out. Many investors believed that the housing market was stable and would continue to grow, which made MBS appear to be a secure investment. MBS were structured to pay regular interest payments, similar to bonds, which made them attractive for investors seeking steady income. The returns were considered to be high relative to the perceived level of risk, especially when combined with the security of a diversified pool of mortgages. Credit rating agencies like Moody's, S&P and Fitch often gave high ratings like AAA to MBS, even those made up of risky subprime loans. These high ratings gave investors confidence that MBS were low risk, which encouraged them to buy more of these securities. To meet this demand, banks needed more home loans to package them into MBS, so they lowered their lending standards and started approving loans for people with poor credit rating. And also during this time, there was a lack of strict regulations in the financial sector. Many lenders engaged in predatory lending practices, where they aggressively pushed subprime loans on borrowers, sometimes without fully explaining the terms or risks involved. Banks even offered adjustable rate mortgages, ARMs, with low initial interest rates to attract subprime borrowers. These rates would increase after a few years, making the mortgage payments much higher. So the borrowers were enticed by the initial low monthly payments, but many couldn't afford the higher payments once the rates adjusted, leading to defaults. Many loan officers and mortgage brokers were also given bonuses and commissions based on the number of loans they approved. So, this created an incentive to approve as many loans as possible, regardless of whether the borrower could actually afford them. The focus was on quantity over quality, leading to more subprime loans being issued. The market for MBS had grown significantly, making them highly liquid, which is easy to buy and sell. This liquidity was attractive to investors who wanted the flexibility to quickly enter or exit positions. The size and growth of MBS market provided many opportunities for investors to buy large quantities of these securities. So investors like pension funds, hedge funds and financial institutions were drawn to mortgage-backed securities because they offered higher returns, were perceived as safe due to high credit ratings, provided diversification and seemed to benefit from the booming housing market. So this demand contributed to the rapid growth of MBS market, ultimately leading to a heavy buildup of risk. Now let's talk about credit default swaps or CDS. A CDS is essentially insurance for investors who buy MBS, that is mortgage backed securities. So here is how it works. If the MBS loses value because homeowners stop paying their mortgages, the seller of the CDS, usually a large financial firm like an insurance company or a bank, promises to cover the losses for the investor. Investors paid a fee for this protection, just like how we pay insurance premiums. These CDS contracts were attractive because they seemed to provide a safety net. However, the problem was that many financial institutions sold CDS on risky MBS, mortgage backed securities, without having the money to back up their promises. They underestimated the risk, assuming the housing market would always stay strong. Many participants use CDS for speculation rather than for hedging. This means they were betting on the failure of securities without actually owning them. The market was flooded with speculative bets, which amplified the impact. Everything seemed fine until home owners began defaulting on their subprime mortgages. This is where the domino effect started. As more home owners defaulted, the value of mortgage backed securities began to drop. Investors who thought they were holding safe investments suddenly found themselves facing huge losses. Those who sold CDS, that is credit default swaps, that is insurance giants like American International Group AIG, were hit hard. They had agreed to cover the losses on MBS but didn't have enough cash to fulfill their promises. So, this led to a massive financial strain on these institutions. As the MBS lost value and CDS sellers couldn't cover their obligations, big financial institutions that were heavily invested in these products began to collapse. Notable examples include Lehman Brothers, which went bankrupt, and AIG, which required a massive government bailout to stay afloat. One of the major issues that amplified the crisis was over leveraging. Many banks and financial institutions borrowed a lot of money to buy MBS and CDS, thinking they would earn huge profits. However, when the value of these assets plunged, they couldn't repay their debts. The collapse of firms like Lehman Brothers and the near collapse of others like AIG caused widespread panic. These institutions were interconnected with many other banks and businesses, creating a ripple effect throughout the global financial system. The collapse of major financial institutions led to a freeze in the credit markets. Banks became afraid to lend money to each other, let alone to businesses or consumers. So, this lack of credit caused a severe slowdown in economic activity. Companies couldn't get loans to fund their operations, consumers couldn't get mortgages or credit, and the economy began to slow down. The result was a global recession. Millions of people around the world lost their jobs, homes, and savings. Stock markets tumbled and economies shrank as businesses closed down and unemployment soared. To prevent a complete collapse of the financial system, governments around the world had to step in with massive bailouts. In the United States, the government used taxpayer money to rescue failing banks and financial institutions. For example, AIG received a bailout of over 180 billion US dollars to prevent its collapse. These bailouts were controversial but were seen as a necessity to stabilize the economy. The crisis highlighted the dangers of unregulated derivatives trading. To prevent something similar from happening in the future, the Dodd-Frank Wall Street Reform and Consumers Protection Act was introduced in 2010. This act aimed to make the financial system safer by increasing transparency. Certain derivatives had to be traded on exchanges or cleared through clearing houses, making it easier to track and regulate them. The Act set new rules to reduce the risks associated with OTC, over the counter trading, especially for complex derivatives like CDS, that is, credit default swaps. New regulations were also put in place to protect consumers from risky practices that led to the crisis. The 2008 financial crisis taught us that derivatives, while useful for managing risk, can also create significant instability when misused. To sum it up, derivatives played a significant role in the 2008 financial crisis. But it wasn't the derivatives themselves that were the issue, it was how they were used. The crisis showed us the dangers of excessive risk taking and the importance of transparency and regulations in the financial markets. As we move forward, these lessons remain crucial in ensuring the stability of our financial systems. So, thank you for joining this lecture. I hope this gives you a clearer understanding of the role derivatives played in the 2008 financial crisis and the lessons we can learn from it. Thank you.